The most dangerous banking secret in the modern world is not hidden in a vault. It is hidden in plain sight, on balance sheets, in deposit categories, in accounting footnotes, in reserve ratios, and in the fragile psychological contract that tells ordinary people their money is there, even when the system itself admits that the promise is conditional. Call it the $8.5 trillion banking secret. Call it the invisible layer of money that exists safely only as long as confidence remains intact, but do not call it an accident. This is not a random vulnerability. It is the predictable result of a repeatable financial pattern that has appeared again and again across centuries. And right now, the numbers are flashing the same warning. U.S. banks ended 2025 with about $25.3 trillion in assets. Unrealized losses on securities were still $306.1 billion, even after falling from earlier levels. The FDIC's problem bank list rose to 60 institutions. Meanwhile, the Deposit Insurance Fund stood at $153.9 billion with a reserve ratio of 1.42%, while global debt hit a record $348 trillion and U.S. federal debt held by the public climbed above $30.8 trillion in late 2025. That is not stability. That is a system stretched across time, leverage, and faith. And once you see the pattern, the question, is your money safe, stops being a sentimental question and becomes a structural one. Because banking systems do not fail when they are hated. They fail when they are trusted too easily. They fail after long periods in which safety is marketed, convenience is normalized, yield is chased, balance sheet mismatches are ignored, and political authorities quietly assume that public confidence can be managed indefinitely. Then one trigger arrives, not always the same trigger. Sometimes it is war, sometimes inflation, sometimes a collapse in collateral values, sometimes a sudden rise in rates. Sometimes a digital-era bank run that empties accounts faster than 19th century panic ever could. But the mechanics do not change. The language changes. The technology changes. The speed changes. The machine does not. The machine always runs in 4 stages. First comes the foundation, the promise of safety. This is the stage where institutions persuade the public that deposits are secure, that the sovereign is credible, that rules are durable, that cash equivalents really are equivalent to cash, and that maturity transformation is a harmless miracle instead of a permanent vulnerability. Then comes expansion. Credit grows faster than real resilience. Assets are extended further in duration. Leverage rises, and what began as prudence is converted into scale. Then comes the break. Some external pressure exposes the mismatch between liquid promises and a liquid reality. It may be deflation, inflation, rate shock, war finance, real estate collapse, or simple depositor fear. Finally comes the outcome. The state intervenes, socializes losses, changes rules, redefines money, and restores order at a higher level of centralization while telling the public the crisis was exceptional. It was not exceptional. It was the completion of the pattern. That is the systemic revelation. Banks are not primarily vaults. They are transformation engines. They take short-term liabilities that can flee and place them against long-term assets that cannot. Then they rely on law, confidence, and central bank liquidity to bridge the gap. That is why the public experiences banking as safety, while the system experiences banking as timing risk. When times are calm, this looks efficient. When stress hits, the entire structure depends on how much confidence is left, how much collateral can still be pledged, how rapidly losses are recognized, and whether the state chooses to save the promise or let the fiction collapse. The difference between my money is safe and my money is stuck is often not solvency in the abstract. It is sequence. It is whether you need your claim before the system can convert its assets without destroying itself. History proves this with brutal consistency. Start with the United States in the early 1930s. Stage 1 was the promise. Before the banking panics reached full force, Americans had been conditioned to believe their deposits were money because banks were institutions embedded in local economies and tied to a national monetary order. The ordinary depositor did not think in terms of asset-liability mismatch. He thought in terms of trust, reputation, and routine. The system rested on that trust. But under the surface, thousands of banks were structurally vulnerable to credit deterioration, depositor withdrawals, and contraction in money and credit. Then stage 2 arrived, expansion and overextension. The 1920s produced credit growth, speculative excess, and a banking system dispersed across many institutions with uneven resilience. Loans were made into a boom. Asset values were inflated by confidence and leverage. The banking structure was fragmented and brittle. When conditions turned, what looked like abundance became exposure. The money supply was more confidence-dependent than the public understood. Stage 3 was the break. Bank panics in 1930 and 1931 began regionally, but by late 1931, the crisis spread nationally. Depositors did what depositors always do when doubt enters the room. They asked for immediacy. They asked for cash now, not reassurance tomorrow. And banks, which had promised liquidity on demand against assets that could not be liquidated cleanly at scale, began to fail. The FDIC's own historical account records hundreds of suspensions during the 1931 waves, while Federal Reserve history describes how a regional panic became a nationwide crisis from 1931 to 1933. Then came Stage 4, the regime change disguised as rescue. In 1933, the answer was not to pretend the old promise had worked. The answer was to redesign the credibility architecture. The Banking Act of 1933 created the FDIC. Deposit insurance was not merely a consumer protection measure, it was a political technology for stabilizing confidence by transferring the credibility of deposits away from individual banks and toward the sovereign-backed insurance framework. That is the key lesson. When trust in the decentralized promise failed, the state did not eliminate the pattern. It moved the promise up one level. Safety was restored by centralizing the guarantee. The crisis did not end the machine. It reorganized it. Now move to the second case study because many people wrongly assume deposit insurance solved the problem forever. It did not. It changed the form of the pattern. Look at the late Bretton Woods era, the Nixon shock, and the savings and loan disaster that followed. Stage 1 again began with the promise. After World War II, the United States sat atop a monetary order in which the dollar anchored global finance and, internationally, dollar convertibility into gold served as the credibility mechanism for the system. Domestically, thrift institutions and banks operated within a regulated environment that made long-term lending appear stable. The promise was that the monetary order was durable and that fixed structures could safely fund long commitments. Stability itself became the sales pitch. Then came Stage 2, expansion. As the post-war order matured, the United States ran growing external pressures and domestic inflation pressures. The Bretton Woods design depended on confidence that the United States could maintain convertibility and discipline simultaneously, but systems based on promises weaken when issuance outruns restraint. By 1971, the tension between domestic policy goals and the international promise of gold convertibility became too great. The Nixon administration closed the gold window on August 15, 1971, beginning the end of Bretton Woods. Federal Reserve and State Department histories are clear. The move was a response to inflationary pressure and a looming run on U.S. gold. In other words, the promise had expanded beyond what the reserve anchor could sustain. That was not the end of the pattern. It was the transition into Stage 3. Once the anchor changed, the entire interest rate environment changed with it. Inflation surged through the 1970s, then rates rose sharply, and that exposed another mismatch, this time inside the thrift sector. Savings and loan institutions had funded long-term fixed-rate mortgages with short-term deposits. When inflation and interest rates exploded, savers wanted better yields elsewhere, while the asset side remained trapped in lower-yield long-duration loans. Federal Reserve history explains the trap directly. Deposit rates that thrifts could pay were constrained, savers withdrew funds, and institutions were squeezed between rising funding costs and fixed-rate asset books. The same machine, short liabilities, long assets, broken confidence in the middle. And then Stage 4 arrived, as it always does: political improvisation, regulatory forbearance, and socialization of the damage. Rather than admit immediately that the old structure was failing, authorities loosened rules, widened lending powers, delayed recognition, and tried to buy time. That is what systems do in the late phase. They do not confess, they stretch. But stretching a broken system does not heal it. It multiplies the cost. FDIC history shows that in 1980, the FSLIC insured about 4,000 thrifts with $604 billion in assets, and the crisis of the 1980s and early 1990s ultimately produced more than 1,600 commercial bank failures and over 1,000 thrift failures, with massive taxpayer costs and institutional restructuring. Again, the pattern completed itself: promise, expansion, break, rescue plus redesign. Now the third case, the 2008 global financial crisis. This is perhaps the purest modern expression of the machine because it occurred in a supposedly sophisticated era, with quantitative models, capital rules, derivatives, ratings, securitization, and endless claims that modern finance had diversified risk away. Stage 1 was the promise of safety through engineering. Mortgages were originated, securitized, sliced, rated, insured, and distributed. The story sold to the public and to institutions alike was simple: Home finance had been transformed from local banking risk into global, diversified, market-priced stability. Depositors trusted banks, investors trusted securities, money markets trusted collateral, everyone trusted ratings. This was the new language of safety. Then stage 2, expansion. Credit loosened. House prices rose, leverage climbed, short-term wholesale funding ballooned. Risky mortgages were not merely issued, they were embedded throughout the financial system. The Financial Crisis Inquiry Commission concluded that trillions of dollars in risky mortgages had become embedded across the system, while leverage, weak regulation, and unregulated derivatives magnified the vulnerability. That is the central point. Complexity did not remove the pattern. Complexity hid it. Then stage 3, the break. The housing bubble turned. Mortgage losses appeared. Confidence in collateral deteriorated. Short-term funding markets froze. Institutions that looked liquid were revealed to be dependent on continuous rollover. And because the system was tightly interconnected, uncertainty about one node spread across the entire network. The FCIC described how the collapse of the housing bubble ignited a chain of events leading to full-blown crisis, and how inconsistent official responses deepened panic. That is important. Panic is not simply emotion. In banking, panic is information arriving all at once about the mismatch that was always there. Then stage 4, rescue, concentration, and a new moral order. Emergency lending facilities multiplied, guarantees expanded, major firms were merged, saved, or resolved. Rules were rewritten. Central banks became even more central. The system survived, but not because the pattern was disproven. It survived because the sovereign and the central bank once again stepped between the public promise and private fragility. Every crisis ends with the same message from authority. Order has been restored. What it rarely says is this: order has been restored by changing the definition of who ultimately stands behind the promise. Now bring the same pattern into the present and watch how coldly the pieces lock into place. Stage 1, the promise of safety. Today, the public still behaves as if deposits are stored wealth rather than claims on leveraged institutions. The average person hears FDIC insured and assumes the issue is settled. But insured up to a limit is not the same thing as universally insulated from stress. The FDIC itself notes it insures over $10 trillion in deposits. That is a powerful backstop, but the existence of insurance does not erase concentration risk, duration risk, or the dependence of very large, uninsured balances on confidence and speed of policy response. And the Office of Financial Research notes that after the 2023 run on deposits at Silicon Valley Bank and other mid-sized banks, the ratio of estimated uninsured deposits to total deposits continued to vary widely across institutions. In other words, safety is not uniform. It is tiered, estimated, and confidence sensitive. Check. Stage 2, expansion and overextension. The industry's own data show that U.S. domestic deposits kept rising through 2025, and that estimated uninsured domestic deposits drove much of the increase in the fourth quarter, rising by $214.7 billion. Total loan balances grew to $13.5 trillion, the fastest annual growth rate in 11 quarters. The industry still carried $306.1 billion in unrealized securities losses at year-end 2025, even after a sizable decline from the prior year. And in 2024, total domestic deposits were already $17.7 trillion, with uninsured deposit growth resuming. This is the critical structural point. The system has continued to grow while retaining material exposure to duration shifts, deposit concentration, and asset-side valuation pressure. It has not been reset to some riskless baseline. It has been normalized into a new late-cycle equilibrium, verified. And notice what else has expanded around the banks. Global debt reached a record $348 trillion by the end of 2025. U.S. federal debt held by the public exceeded $30.8 trillion in Q4 2025. Domestic non-financial U.S. debt was nearly $79.7 trillion by Q3 2025, including $36.9 trillion in government debt. That matters because banks do not operate in isolation. They exist inside a debt-saturated macro regime in which sovereign borrowing, private leverage, and monetary policy all interact. A bank can appear stable on its own statements and still be vulnerable to a rate structure, refinancing burden, or collateral repricing generated by the larger debt machine around it. Undeniable. Stage 3. The break condition. Has it happened? Not fully. Has the system already shown us the trigger mechanism? Absolutely. The OFR explicitly references the 2023 run on uninsured deposits at Silicon Valley Bank and other mid-sized banks. The Federal Reserve's 2025 supervision report also notes that commercial bank deposits reached a historic high in August 2025, while uninsured deposits as a share of assets and deposits remained below late 2022 peaks, meaning the issue is not gone but monitored. Money market funds, meanwhile, have swelled because they can offer more attractive yields than many bank deposits. The Fed reported $7.1 trillion in MMF assets by July 2025, and other industry reporting put money market assets near $8 trillion by year-end 2025. Translation: in a digital system, deposits can now leave not just because of fear, but because of convenience plus yield. That means the modern run trigger is broader than old-fashioned panic. It can be fear or arithmetic. Fear says move. Yield says move. An app lets you do it instantly. Check. This is where people misunderstand what safety means. They think the relevant question is whether the banking industry is fine in aggregate. But aggregate fine is not the same as individually liquid. The system may have enough capital in general, enough collateral in theory, enough central bank lending capacity in emergency, and enough political will to contain a broad panic. That does not mean every depositor is equally protected in the same way at the same speed under the same stress. The OFR notes banks can prepare for large withdrawals by posting collateral at the Federal Reserve and Federal Home Loan Banks. That sentence is more revealing than it first appears. It means deposit stability in the modern era is inseparable from access to state-linked liquidity plumbing. Your money is safe not simply because the bank is strong, but because the bank can transform eligible collateral into cash quickly enough to meet the promise. That is not a vault model. That is a refinancing model. Verified. Now stage 4, the inevitable outcome. If stress intensifies again, what happens? Not because I am predicting a date, but because the pattern leaves only a small menu of responses. Authorities can extend guarantees explicitly. They can expand emergency lending. They can widen collateral eligibility. They can facilitate mergers. They can protect uninsured depositors selectively or broadly. They can absorb losses more gradually through accounting flexibility. They can let a few institutions fail while ring-fencing the rest. But every one of those options has the same architecture: move the promise upward, shift private confidence dependence into public balance sheet credibility. That is how modern systems survive, not by being free of fragility, but by transferring fragility onto larger institutions with stronger legal powers. Check. And this is why "this time is different" is one of the most expensive phrases in finance. American exceptionalism says the dollar system is too central to break in any meaningful way. Modern optimism says regulators have more data, more tools, more stress tests, more coordination, more backstops. Technological optimism says faster payments, better apps, AI risk systems, and real-time surveillance will make banking safer. But technology cuts both ways. The same tools that improve monitoring also accelerate runs. The same digital convenience that makes banking frictionless makes withdrawal frictionless. The same centralized backstops that calm markets also enlarge moral hazard. Complexity does not end the pattern. Complexity increases the speed at which the pattern unfolds. And let us be precise about what the title question really means. Is your money safe? Does not mean, will the entire financial system vanish tomorrow? That is lazy thinking. The real question is sharper. Safe from what? Safe from nominal loss under insurance limits? Maybe if your structure is correctly insured and your institution is covered. Safe from delayed access during a resolution event? Not necessarily. Safe from inflation eroding purchasing power while authorities rescue nominal claims? Certainly not. Safe from rule changes under crisis conditions? History says no system is immune to those. Safe from the quiet conversion of a private banking problem into a public balance sheet problem that then returns to households through inflation, repression, taxation, or lower real yields? Again, history says no. That is the secret. The banking system does not merely hold your money. It interprets your claim on money through a hierarchy of promises. At the bottom is the bank. Above that is deposit insurance up to specified limits. Above that is the central bank's liquidity power. Above that is the sovereign's fiscal credibility. Above that, ultimately, is the public's willingness to continue believing that nominal claims will remain convertible into real purchasing power without penalty. When you ask whether your money is safe, you are really asking whether that entire ladder remains intact under stress. And ladders do not fail only at the bottom rung. So what should the ordinary viewer do with this? Not panic. Panic is for people who understand only the event and not the structure. The correct response is discipline. First, understand your actual exposure. Know what is insured, what is not, how your accounts are titled, and where your liquidity would come from in the first 72 hours of a disruption. Second, Distinguish liquidity safety from purchasing power safety. A nominal guarantee is not protection against inflation, currency debasement, or suppressed real returns. Third, stop believing that convenience equals security. The easier money is to move, the faster the entire system can become confidence sensitive. Fourth, respect concentration risk. The larger the uninsured balance, the more you are no longer behaving like a depositor and are behaving like a short-term creditor who just happens to call the claim cash. That is not fear-mongering. That is classification. And above all, understand the machine, because people who do not understand the machine always become raw material for it. They trust slogans, they trust branding, they trust the emotional memory of calm periods, they trust the phrase well capitalized. They trust that a federal acronym means a timeless guarantee. They trust that because the last rescue worked, the next rescue will work in the same form, at the same speed, with the same political consent. But history does not promise identical rescues. It promises repeated strain, repeated improvisation, and repeated transfers of burden. The final warning is simple. Every banking era believes it has solved the old banking problem. Every era then rediscovers that the old problem was never eliminated. It was relocated. In the 1930s, the problem was local bank fragility and confidence collapse. In the 1970s and 1980s, it was monetary regime stress and duration mismatch inside insured institutions. In 2008, it was securitized leverage and wholesale funding fragility. In the 2020s, it is a combination system. Sovereign debt overload, unrealized asset losses, concentration of uninsured deposits, digital transfer speed, and public dependence on central bank backstops. Different surface, same logic. So no, this time is not different. It is more connected, more instantaneous, more debt-saturated, more policy managed, which means the margin for error is smaller, not larger. The pattern remains absolute. Promise, expansion, break, centralization. Promise, expansion, break, centralization. Again and again until the public finally understands that what it calls safety is often just confidence renting time from leverage. Do not be caught unaware. Position yourself in reality, not in marketing. Audit your assumptions. Understand the plumbing. And if you want to know how this machine was built, how governments learned to rescue confidence without curing fragility, and what the next stage of this pattern looks like when debt, banking, and the state all reach their limits at once, subscribe now and watch the next video. Because the people who survive systemic shifts are not the ones who saw the headlines first. They are the ones who understood the pattern before the headlines arrived.